Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, I'd like to dive into a specific topic. For those of you who have followed my channel since we began last year, you know that the original focus was more intensive on Bitcoin on-chain and derivatives. But as the economy began to turn earlier this year, more and more of my focus has been on the macroeconomic landscape. And so I get questions often about why I think it's so important. Why have I been spending so much time on it? How does it relate to Bitcoin? So today, I'll try to answer some of those questions as best I can. We'll look at several different charts. We'll look at the debt. We'll look at the stock market. We'll look at some other economic indicators. And I'll try to interweave them together and show you how they relate to each other and to Bitcoin. So don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up and subscribe to my channel. We're on the way to 18,000 subscribers. Amazing. Now we have much to discuss, so let's get into it. So today was an interesting Monday. You know, in the markets this morning before the actual stock market opened, in the pre-market, things were pumping pretty strongly. But then by the time we got to the open, things began to sell off and we finished the day essentially negative. Everything was just a little bit red. But it was an unorthodox day. There was some news making because some of the most shorted meme stocks from last year were ripping today. Here's a look at AMC. GameStop was also up real big, and Bed Bath & Beyond had a monster day, and these were all mostly short squeezes. And you know, when we get into these bear market rallies, they can really confuse low information market participants because they can give the misguided impression that there's a renewed strength in risk appetite, that there's a new rush to buy assets, when in fact it's more of an artifact of a low liquidity market where there's less competition for price, and these kinds of volatile moves are much more likely to happen. So when you've got things like Bed Bath & Beyond having a monster day while the rest of the stock market is kind of ho-hum, that's not something to get too excited about. But what we'll talk about today is really more related to the economy. And I get questions sometimes like, why are you so focused on the economy when the stock market and Bitcoin can kind of do whatever they want? That is true to a degree and maybe on shorter time frames. But broader, bigger picture, which is more of the perspective I focus on, they're absolutely related to each other, and it's important that we follow both of them. So maybe on a short time frame, you could see Bitcoin have an up day while the market has a flat or red day like we got today. But it is important that we have a holistic perspective, particularly when the market is in contraction. When things are really bullish and most assets broadly are moving up and the economy is expanding, then we can start focusing more on individual markets and looking for divergences that might tell us more of the story. But right now, I think it's much more important that we watch for improvements in the economics. And to those folks who think that the economy and the stock market are not the same thing, they are increasingly related to each other over time. This is a look at the stock market to GDP. This is often called the Buffett indicator. It was made popular by Warren Buffett. It's something that he looks at. Essentially, it's the market cap of the stock market to the US economy, to our productive output as a people. This value has been growing. It started here in 1979. It shot up during the tech bubble around 2000. This horizontal dashed line represents 100%. So when this chart is at the dashed line, it means the stock market and the US economy are the same size. Well, you can see where it is now. It's up here at 1.7. It topped out close to 2, which is 200%. That was in December. It's now around 170%, which you can see is, with the exception of the recent high, a historical high. So the valuation of the stock market is really important, particularly for an economy that is powered by spending, where people need to feel financially comfortable and secure and wealthy in some cases so that they can go out and spend money in the real economy freely to drive expansion, to speculate, to buy various products. So when the stock market is coming down, it has a very real, palpable effect that we can see as a knock-on in other indicators that causes people to spend less money. They feel less wealthy. This is a concept concept we've been exploring over the last few months. In one of my videos a couple months ago, I talked about the reverse wealth effect, that the Federal Reserve was trying to engineer a weakening in the feeling of financial security in Americans because they perceive the economy to be too hot. They see spending numbers, nominal spending remaining high, inflation continues to print new highs, unemployment continues to remain very tight. So to them, engineering people feeling less rich is a way to slow the economy down. And that matters a lot when you think about how much wealth is concentrated in the stock market. This is a look at equities as a percent of US household wealth. You can see it's pretty much at all-time highs. It was at a recent high in the middle of last year. Its previous all-time high was the tech bubble, and before that, going all the way back to 1968. So the valuation of the stock market is increasingly important for the financial security and the perception of financial wealth for Americans who have exposure to the stock market. Now, there are other statistics you can look at that say that not everyone has stock exposure, and this only matters for a certain portion of Americans. That is also very true, but it's relevant to point out that people in the top half of incomes do most of the spending in terms of contributing to GDP growth because they have more money available to spend, but they're not necessarily so wealthy that they're just hoarding cash and financial assets. So there is a balance in between there. And the people who have stock exposure increasingly see a share of it representing their net worth. And what I'd like to explore a little further now is how Bitcoin relates to all this. We're talking about stock market valuations and how it relates to people's spending. Well, that also relates to Bitcoin and its performance because it is an asset denominated in local currencies like everything else. And even though Bitcoin is a monetary asset and it has its own unique properties, in large part, market participants treat it like a speculative vehicle. At this point of its life cycle, it's still very much speculative. People buy it hoping the price goes up so they can sell it again. That's the majority of the behavior. So we look at Bitcoin the same way we look at equities and other speculative assets. And they really are driven by the health of the economy and people's willingness to spend and debt levels. So let's explore those concepts a little further. So I mentioned debt levels. We talk about debt a lot on this channel because it is the basis of the monetary system. Most of the money in circulation has been lent into existence. What we're looking at here is all debt across all sectors in the United States compared to GDP, compared to the size of the economy. So this includes public debt, household debt, corporate debt, state and local governments, everything bundled together as a percentage of the economy. And you can see we've been over 100% as far back as my data goes here to 1954. I could get older data, but we'll start from here. And where we are today is around 370% of debt to GDP. That's all sectors, and it's been growing really strongly since the 90s, really. You can see it took a leap here in the 80s and then really started ramping up in the late 90s, early 2000s. A couple of videos ago, we explored the history of the debt. We explored how it really exploded around 1971, middle 1970s, when Nixon closed the gold window and ended convertibility. And ever since then, deficits have really been expanding and the debt level has been expanding year over year, decade on decade. And it's been happening across all sectors. Like I said, right now, all sectors combined, it's 370%. If we break that out and we look at it by group, you can see the trend for most of these groups is up. The only real cohort out of all of these that's remained pretty flat are state and local government debt. But other than that group, all of these others have been rising. We've got household and nonprofit debt, which is at 75% of GDP. You can see back here in the Great Financial Crisis, it almost reached 100%. It almost matched the size of the economy, the amount of debt in the household sector. Likewise, the financial sector. These are other banks, hedge funds, etc., asset allocators. Their debt to GDP was over 120% during the Great Financial Crisis. And you can see, just like household debt, it came down swiftly after that, while federal government debt to GDP exploded. One of the things that occurred during the Great Financial Crisis, we bailed out a lot of very bad money. There was a lot of unserviceable debt out there that far exceeded the productive output of the economy. You can see here just these two separate sectors had as much debt as the entire size of the US economy. So what did the federal government do? Well, they They exercised about $16 trillion to uphold the obligations of the private sector, and they converted that bad money to a sovereign liability. And in doing so, they greatly expanded the public debt at the same time that those two sectors saw their portion shrinking. The liability was transferred to the federal government, which essentially means it was transferred to the taxpayers. The public is always the ultimate loser. But as a result of this continued expansive indebtedness, including the corporate sector, you can see corporate debt also continues to climb. It's now at 50% of GDP. Because of our continued indebtedness, the flow of debt and the availability of credit, the conditions in the credit markets are very influential on the performance of the stock market and assets broadly. Because we have markets that operate on participants getting levered up to speculate on the future continuing to be just as good as the present. And we have these boom and bust cycles over and over again. To demonstrate how important debt is and how it flows with assets, this is a look at margin debt versus stock market performance. Margin debt is the leverage that financial institutions take out to buy other financial assets. And what you can see is as margin debt, here in green in a year-over-year percentage, as margin debt expands and contracts, the year-over-year percentage change of the US stock market also expands and contracts. They follow each other so closely. As the market sells off, the debt gets crushed either through insolvency, default, or people getting out of their loans. As people lever up, they continue to buy assets and performance increases. So let's look at this with Bitcoin included. Here is Bitcoin. It moves at a higher beta, as we've explored before, because it is a nascent asset, because it has its own market, and it's still relatively small. It's smaller than some of the biggest US companies right now. It has a bigger band of volatility, but the directionality is much the same. So you can see in a period of high returns for Bitcoin, this was the first year, was also a period of elevated margin debt and positive returns for the US stock market. As margin debt and the stock market saw lesser returns here in the middle of 2012. That was also a period of drawdown for Bitcoin. And you can see these oscillations over time. And this is why I always push back on people who say that Bitcoin and the stock market are not related to each other. They absolutely are. If you're looking at a short time frame for correlations, you will be able to prove me wrong, and we can split hairs about all of that. But generally speaking, as an investor, when you look at it big picture, it all kind of moves together. If I zoom it in a little more for you here, you can really see how much Bitcoin follows performance of the stock market and the growth and contraction of margin debt in US markets. They are all symbiotically related. It has to do with the availability of credit broadly. So this is strong evidence upholding the idea that Bitcoin is part of the macro picture like everything else. And just as we evaluate performance in the stock market, we can evaluate likely performance in Bitcoin with the understanding and the knowledge that it can do its own thing. It can break away higher and lower before or after the broader equity markets. However, directionally, they tend to all move the same way because the denominator for all of these assets, in my particular example, is the US dollar. So as the US dollar goes, as credit conditions and dollar conditions go, all of the assets that are the numerator in this valuation are affected. So we've explored the debt levels, we've explored the expansion of debt, and we've now seen how the growth and contraction of debt also relates to asset performance. You're with me so far? Here is the ISM Purchasing Managers Index. This is a survey that goes out every month to about 300 different US manufacturing companies, and it asks them about current and anticipated future business conditions. It has a bunch of different subcomponents that I don't have all the data for because it's paywalled, but this is the primary index that brings all of those components together. Now, the way to read this, it is an oscillator over this 50 median bound. When the value is above 50, that means that the economy is generally expanding, business conditions are positive. When it's below 50, it's the opposite. It means things are negative, they are contracting. It's also a directional indicator. So when you see PMI rolling over from a high and heading down towards 50, you can start to anticipate the economy is already declining, even before it gets to a point of pure contraction below 50, its rate of change of growth has already begun to slow. The momentum has begun to slow. And you can also see that many times that it dips below 50 are aligned with recessions. That's these gray bars here. This is one of the best leading indicators of the economy. You're directly asking business owners how their conditions are faring now, and based on the data they see, how they expect the next 6 months to go. And when you aggregate all that together over time, you get a really clear picture of the directional health of the economy. Now, right now, the PMI is at 52.8, and it has been rolling over ever since March of last year, and it's heading towards contraction. Now, there's another reason that I brought up the PMIs. The PMIs, similar to the way that debt expansion and contraction also moves with assets, the PMIs are a really good cousin to performance in equities. So the blue line is the PMI that we were just talking about. The black line is year-over-year S&P 500 performance. Now, I know it's a little noisy, but if you just kind of back up and you look at it, you can really see how these two metrics move together. So as the PMIs go, as the health of the manufacturing sector in the US goes, broadly speaking, the health of equity markets goes. So we've explored a few concepts here, and I'm laying the groundwork before we look at another chart here in just a moment. We've talked about debt levels. Here is all sector debt to GDP, growing decade over decade and currently at 370% of the size of our economy. We also explored different sector debts on a general decade over decade rise, including this blowout here in the Great Financial Crisis, where the Fed converted a lot of private bad money into public liabilities, and our indebtedness continues to grow. We also looked at the correlation between the expansion and contraction of margin debt with performance in equities and in Bitcoin, before hopping over and looking at the Purchasing Managers Index and how it also follows the movements of the stock market broadly over time. So now that we have linked all of these ideas together, this is Bitcoin compared to some of the indicators we were just talking about. And I'll walk you through this chart. I know it's a little busy here. I have 4 grids. In each grid, I have Bitcoin up at the top and one of the indicators that we were just talking about. Well, at least 3 of them are. I'll explain this 4th one here in a moment. The color coordination has to do with the high and low values of the indicator being applied to Bitcoin up at the top, just so that you can see how they relate to each other. So you can see how well they align. Now, this one up here in the top left, what this indicator is showing is the health of corporate credit spreads, particularly high yield corporate credit. Those are less creditworthy businesses than your regular AAA, BBB borrowers. And I have inverted this here. It's normally flipped the other way around, but I wanted you to have a visual representation. So this is a ranking of corporate credit spreads over time. And I did it this way so that you can see the oscillations between high and low values, between good credit conditions, which are these blue when the value is near the top, and poor credit conditions when the spreads are wider, indicating people are selling corporate debt and there is a lack of appetite to buy bonds to help finance companies. And what do you see when you look at Bitcoin above here? You see Bitcoin bull markets aligning with healthy periods of corporate credit, and Bitcoin bear markets, though it's not perfect, largely aligning with declines and troughs in the quality of corporate credit, more the appetite for it rather than the quality. When the spreads get wider, the market is in bad shape, typically speaking. You can also see here, look, the 2017 and 18 market, also a period of prolonged, tighter corporate credit spreads, also seeing positive asset performance. And again, over here, look at this big decline in corporate credit happening at the same time that Bitcoin is experiencing its bear market. This decline really began in November of last year. So check 1 in the box of Bitcoin connected to the economy. Down here at the bottom, I have one that's a little more simple. This is simply 6-month percentage returns of the total US stock market, specifically what is called the Wilshire 5000 price index. So what I've got on here is 6-month average returns compared to Bitcoin up top. This correlation is a little less tight than the corporate credit one, but still you can broadly see Bitcoin bull market in a period of high returns for the stock market. And then Bitcoin's bear came during a period of structural natural decline, long-term decline over a period of 2 years for the US stock market until its trough came around the bottom of the Bitcoin bear. Then again, some positive returns for a few years in the stock market while Bitcoin has another bull. Then it rolls over, starts to decline, and returns for the stock market also decline into late 2018. So we see, just like we explored on the margin debt chart, the stock market and Bitcoin do broadly move together. It isn't perfect. You wouldn't want to trade it on a narrow time frame with that same idea in mind. But if you're trying to think about directionality over the next few months, quarters, years, etc., it is important to look at everything. Up in the top right, we have the PMIs. This was what we were exploring before in the blue line and how it relates to the stock market. This chart right over here. This is it down here just for the lifetime of Bitcoin. And what do you see? When PMIs are near contraction or at least declining, remember the 50 is kind of the middle for PMIs. As it is declining and nearing 50, Bitcoin was kind of in a trough here. And then as it began to grow and expand, PMIs kind of reversed. This isn't perfect here. The relationship is not exact, but you can see the general trend, the smile here that was created from bull market to bear market to bull market, just like that. Same thing over here in 2015, declining PMI environment even reached contraction for a while. And then as it dug out into a period of economic expansion, was also when Bitcoin had an expansion. Same thing, bear market, contraction in PMIs. So the relationship is holding up across corporate credit, across stock market returns, across the survey of manufacturing conditions. All of them show that Bitcoin broadly moves with them. This last one I've included down here at the bottom, just to kind of round out this whole view, are producer prices, specifically the producer price index. That is the price that US producers are able to get for their products. It comes a little bit ahead of CPI. It's a little further up the chain. It's more like wholesale prices. But you can see here, just in rate of change year over year terms, when it's positive, Bitcoin's doing okay. When it's in a trough, Bitcoin's in a bear market. When producer prices are rising, the economy is healthy. Same thing here. We had an explosion of producer prices in the last 2 years, huge bull market for Bitcoin. This relationship, again, is not perfect. This is one of the weaker of the four. I think the stronger two are really the corporate credit look and the PMI look. But all four of them corroborate the same story. So they are strengthened by the group. And this view here, friends, this is why I have such an interest in the macroeconomy. This is why I think it's so important that we talk about debt levels and employment and retail spending and all of those different things we've been unpacking over the last few months. If we are in an environment of declining PMIs, as you can see in the top right of your screen, if this is going to continue trending down and even break below 50, if corporate credit is also going to continue its decline into lesser quality conditions, then what does that say about the performance of Bitcoin and other risk assets? How will they be able to break out of this very strong relationship economically and do something unexpected? I underweight that probability just based on what I see here. And as other indebtedness continues to grow across various sectors, that will put a headwind on growth potential. At the same time that we know US demographics are changing dramatically, as we've been exploring on this channel for the last couple of months. All of these are headwinds for growth. Now, does that mean that the Fed and other central banks have to step in, provide liquidity, and basically print us into orbit? I don't know. We may see that happen over the next few years, but I do think that they will try to tighten this rig down as long as they can, because they know that once they turn the printer back on, we're stuck with this inflation for a while. We're stuck with these higher prices, and our indebtedness will have not improved before we get to that point. So I hope I was able to paint a cohesive picture for you as to why the macro is so important to the performance of Bitcoin. That even though Bitcoin is a pristine financial asset with unique properties, at this current moment, it's very much a speculative vehicle that is at the behest of the health of the US and global economy. So we continue to watch the data to try to explore historical trends and see if we can get an idea what may come, because there is no clear model for this situation where we've got a tight labor market at the same time that we have record high inflation and exorbitant indebtedness that limits the flexibility of the central banks. This is a very precarious time, and I also find it fascinating. I would not want to live in any other period in human history, so I'm here for it, and I hope that you found this content valuable. If you have any questions or feedback for me, make sure to leave them in the comments to this video. I read all of them, and we will check back in with each other in a couple of days. Make sure you follow me on Twitter at TXMCTrades. As you know, this is where most of my analysis and market observations go when they're not in the videos. Many cases, they make it to the videos anyway. But this is the most active place that you can find me. Also, be aware of scammers. There are a bunch of them now that my following has grown. I will never cold DM you asking you about your portfolio. I don't have a private Telegram group. I don't send emails, and I'm not going to ask you to send me any money. So please be aware of scammers. If you're looking for charting software like what I use to look at the price charts in all of our videos, there's a link in the description below for you to get an account to TradingView. I find them to be the best market software to use for charting, and if you use my link in the description, I think you can get up to like $30 off. If you're interested, check it out. I rambled quite a bit today. I hope you were able to stick with me. Wednesday is the CPI report. We find out what the print is from July. There's expectations that it will be around 8.8%. So we'll check back in after that print and see how the market is reacting to it. And that is where I will leave it, friends. So until we meet again, be kind to each other, take care of yourselves and your families, and we will chat in just a few days. Cheers, everyone.